Hello and welcome. Let's discuss how to add your spouse to your solo 401k. Thank you so much for joining. If you have questions or topics that you'd like to discuss, please chat those over. Yes, please chat over your questions. Thank you so much for joining again. So, we want to start out with some prepared content and then we'll go to the questions. So, feel free to start stacking up those questions. We appreciate the chance to discuss these topics. We go live twice a day, once at 10 a.m. Pacific, 1 p.m. Eastern, and then we're back for this afternoon session at 1 p.m. Pacific, 4 p.m. Eastern. If you subscribe to our YouTube channel and hit the notifications bell, you can just search for My Solo 401k Financial on YouTube. You'll easily find us. Hit that notifications bell. You'll get notified of when we go live, and you'll be able to jump on, see what other people are asking, ask your own question. So we like to come with some prepared content. Today, we're here to discuss solo 401k power couples, how to add spouse to your solo 401k plan. Tomorrow, we'll be back in the morning to discuss mega backdoor Roth, how to combine backdoor Roth IRA and mega backdoor Roth solo 401k in the same year. And then tomorrow afternoon, we'll be back to discuss comparing solo 401k versus Vanguard SEP IRA. But let's jump into today's topic. So as always, the presentation is being provided for educational purposes only. It should not be construed as tax, legal, or investment advice, nor as a solicitation. Of course, if you have tax, legal, or investment questions, we would never discourage you from just speaking to your tax and or legal and or investment advisors. As far as a roadmap of where we're headed, what we want to discuss, we want to discuss some of the top issues around adding your spouse to your owner-only solo 401k plan, some of the top considerations, the eligibility, just mechanically how to add your spouse to your solo 401k. So with that stated, let's jump in. Now, let's lay the foundation as far as a solo 401k. That is a plan for a self-employed individual. So you have to be self-employed with no non-owner, non-spouse, full-time W-2 employees. So if you are, then you'd be eligible to set up a solo 401k. And then the question will come up for those that have spouses is whether their spouse can participate in the plan. And so if the spouse is working in the business and reporting the spouse's own earned self-employment income, then yes, the spouse can also participate. They can also make their own contributions, roll over money, etc. So as far as we're going to start out with some of the top highlights or reasons why folks would want to add their spouse to the solo 401k. And it's because they want to be able to maximize contributions. Each participating spouse can contribute. And so keep in mind that for the first portion of, or I should say, depending on the type of contribution that the person wants to make, they're going to be able to contribute 100% of their self-employment compensation up to the applicable limit. So dollar for dollar, it's not a percentage. So if the two spouses are able to allocate their income, right, working with their tax advisor, then they can really maximize those contributions, right? Because if each spouse, for example, has the income to justify it, each spouse could be contributing up to the overall limit, which for 2024 is $69,000 or $76,500 if you're age 50 or older. For 2025, that limit goes up to $70,000 or $77,500 if you're age 50 or older, or $81,250 if you're age 60 to 63. So each spouse could potentially be contributing these amounts up to these applicable limits if each spouse has the self-employment income to justify it. So if someone has a lot of income and that, they're able to maximize their contributions, if they can work with their tax advisor to allocate some of that income to their spouse, then the spouse could then maybe contribute additional contributions above and beyond that. So they can essentially double their contributions potentially. Another top consideration is whether or not it would be two plans or one plan. So if both spouses are working in the same business, it would be one plan sponsored by that one business, but each spouse would have their own separate accounts into which they make contributions, etc. So one plan means that it's one fee that we would charge. So we charge by plan. So we charge, for example, $650 is our initial cost, which includes the $525 establishment fee plus the first $125 annual fee. Then starting 12 months later, we charge our $125 annual fee that covers the second year. So that would be per plan. So even though there might be two participants, because there's two spouses that are both working in the same business, our fee would stay the same at that $650 fee as that initial cost. Now, if both spouses are going to participate, each spouse will need their own separate account or accounts. So on top of that, if you have multiple participants and they're making multiple types of contributions, let's say that each spouse wants to make mega backdoor Roth contributions. Well, then each spouse would have a pre-tax, Roth, and after-tax account for a total of 6 accounts. This is a good visual as it shows us how that 6 accounts would look, how those 6 accounts would look. Another top reason, in addition to contributions, that customers will want to set up a plan with us is the ability to take a 401k loan. And so our plan does allow for solo 401k loans. And when you withdraw money as a solo 401k loan, that withdrawal is not subject to taxes or penalties as long as it's properly documented as a loan and paid back according to the loan schedule. We handle the loan documentation requirements as part of our service as an optional free service. In other words, no additional charge. Customers just have to request it right before they take the loan, and then we'll prepare those loan documents within 1 business day. Now, each person is able to borrow up to 50% of their account balance, not to exceed $50,000. So if each person has at least $100,000 in their solo 401k accounts, each spouse would be able to take a $50,000 loan for a total of $100,000 between the two. And then each spouse would be responsible to pay back the loan to their account. Another good feature of 2 spouses both participating in the solo 401k plan is that they'll be able to easily pool their money to invest in alternative investments, because ultimately the investment is made at the plan level. So let's say you have 2 spouses, both working in the same business, both participating in the same solo 401k plan. Each spouse, let's assume, has separate pre-tax solo 401k accounts, and they're both looking to pool their money together to invest in a real estate investment. Well, in that case, that real estate title would just show the name of the plan. It wouldn't reflect the fact that multiple solo 401k participants were pooling their money together to invest in that particular investment. The fact that multiple solo 401k participants, in other words, 2 spouses are both investing their solo 401k funds in that same investment, that's tracked at the plan level. So the title to the real estate would just show the name of the plan. The funds would be transferred, say, to the title company from the respective spouses' accounts. Now, going forward, for administrative ease, all the income and expenses related to that investment could flow in and out of just one of those solo 401k spouses' participant accounts. And then they would just need to reconcile between the 2 accounts, right, to allocate, right, the post expense income according to the original investment percentages. So if 60% of the money came from one spouse's funds and 40% came from the other spouse's solo 401k funds, ultimately those net proceeds would have to be allocated in accordance with those same investment percentages, even though for administrative ease, all the income and expenses related to that investment is going out of just one person's account. So we're going to go through a few practical considerations and tips, and then we'll turn to the good questions. So in terms of some of the practical considerations and tips, related to the topic of how to add a spouse to your solo 401k. We've alluded to some of these considerations, but just to really emphasize it, both spouses can participate in the solo 401k, provided that each spouse is working in the business and reporting their own earned self-employment income. There's no hour requirement. One spouse could just be working the majority of the time in the business, and the other spouse could be just working a little bit. And as long as they're both reporting their own earned self-employment income, they both can participate in the plan. The spouses don't need to both own the business. They just need to both be working in the business and reporting their own earned self-employment income. So whether that's separate W-2s or they file separate Schedule Cs, etc. Obviously, the business cannot have any non-owner, non-spouse employees. That's one of the prerequisites to be eligible to set up a solo 401k. There can't be any other businesses owned by either spouse that has non-owner, non-spouse W-2 full-time employees, because under the control group rules, even if it's an unrelated business in terms of the nature of the business, those two businesses that are owned by one or both spouses are going to constitute a control group, which means that an employee that's working for another company that's part of that controlled group will be considered an employee for purposes of the plan and will therefore preclude the solo 401k plan being established in the first place. As we discussed, if it's one plan, one business that both spouses are working in, it'll be one plan. It'll just be one EIN number. So each account that's set up for the spouse will be set up under that same EIN number, but one will be for the benefit of one spouse, another will be for the benefit of the other, and then there may be additional accounts if there's different types of funds, like pre-tax, Roth, and after-tax. Each spouse will be a trustee of the plan, which means that each spouse has signing authority. Now, how you dictate who inherits your solo 401k funds when you pass away is governed by the beneficiary election form. So if each spouse is participating in the solo 401k, each spouse would fill out their own beneficiary election form to designate who will inherit their solo 401k when they pass away. And obviously, it's permissible to list the other person, the spouse, as the sole primary beneficiary. And then you could have secondary beneficiaries in the event that your primary beneficiary predeceases you. Now, if your spouse is your sole primary beneficiary, then that beneficiary election form doesn't need to be notarized by the spouse. If your spouse is not the sole primary beneficiary, then your spouse would need to sign that beneficiary election form to consent to that in front of a notary. All right, so we'll circle back and talk more about the deadline to make contributions, but I do want to take some time to go through some of these good questions. We really appreciate the fact that you're bringing the questions. Yes, it's an open forum. We'd like to start out with some prepared content just because it's some of these top topics that we talk about every day with our customers. But we love to talk about solo 401ks generally. So any question you might have, it's an open forum. So we appreciate you bringing it. For solo 401k after-tax contribution, rollover, convert to Roth IRA, do we need to fill out Form 8606? No. Form 8606 does not apply to a solo 401k. Now, it may need to be filled out by the Roth IRA provider, but it doesn't need to be filled out by the solo 401k plan provider for the transfer out from the after-tax solo 401k to the Roth IRA. Now, that transfer out from the voluntary after-tax solo 401k account to the Roth IRA account is reportable on a Form 1099-R. And we handle that as an optional free service for our customers. We have an online form that customers use to let us know about that after-tax to Roth IRA transfer. If you just go to our website, mysolo401k.net/forms, you can easily find that form. Thank you for bringing the good question. Thank you so much. One of my clients who uses you for a third-party administrator has two jobs. Keep in mind, we're technically the plan provider, not the TPA, but we do provide the compliance support services as mentioned up above in the last answer, such as the 1099R. He is a Hawaiian airline pilot and also has a separate unrelated business. It is run as an S Corp, and he also has a solo 401k there. Hawaiian Airlines contributes about $35,000 or $40,000 as an employer contribution to his Hawaiian 401k. Does that impact his solo 401k employer contribution? Great question. So the answer is no, because the employer contribution limit, as well as the voluntary after-tax contribution limit, is the 415C limit. So it applies at the plan level, in other words. So in other words, one's ability to make employer contributions to the solo 401k, as well as voluntary after-tax contributions to the solo 401k, is not reduced or impacted by contributions made to an unrelated plan, such as a 401k plan sponsored by his day job employer. Now, the one exception to that general rule is the 403B exception. So contributions to a 403B, whether made as an employee, or as an employer, together with any contributions that the person wants to make to the solo 401k, the sum of those contributions cannot exceed the overall limit. But contributions to a day job 401k plan would certainly not reduce the ability to make solo 401k employer contributions. My understanding is that he has one employee contribution between the two plans. That is correct. The employee contribution limit applies at the employee level. So if the individual maxes out their employee contributions to their day job plan, that means they won't be able to make any more employee contributions to the solo 401k. But if they have the self-employment income to justify it, they could contribute up to the overall limit between employer and or voluntary after-tax contributions to the solo 401k. So for example, if they have the self-employment income to justify it and they set up, they could go up to $69,000 for 2024 to the solo 401k, and it's not reduced by those employee and or employer contributions made to their day job 401k. So you're exactly right. The overall limit is assessed plan by plan, with the one exception being the 403B exception. Exactly. No, it's not. This is why employers don't have to ask their employees whether or not they make contributions to another plan through some other employer. Because if the limit did apply across the board, they would have to ask that question so they wouldn't end up in an excess scenario. Okay, now let's talk about the deadline to make contributions. And thank you so much for the good questions. If you're finding this to be helpful, please like our video on YouTube as it helps us get the word out. Please subscribe to our YouTube channel so you get the notifications of when we go live and the content that we bring. But we really appreciate that you taking the time to join and to ask these great questions. All right, when is the deadline to make contributions? Well, it depends. So if someone signed up with us before the end of last year or had set up, say, a basic plan at a discount brokerage, like say Fidelity or Schwab before the end of last year, they could upgrade their plan to our plan. Or if they signed up with us before the end of last year, then they would have already have our plan, which means that regardless of their business type, they can make all types of contributions, whether employee, employer, or voluntary after tax, by the business tax return deadline, including extension here in 2025. But if they didn't sign up with us before the end of last year, or they didn't have a basic plan set up somewhere else before the end of last year, then they can still make 2024 contributions, but it'll be in a more limited fashion. The type of contribution that they can make will depend on how their business is taxed. Now, if their business is taxed as a sole proprietor, it's still possible to set up a solo 401k plan and make all types of contributions for 2024, even employee, employer, and voluntary after tax. But they would have to make that employee contribution by April 15th. Otherwise, they could still set up a plan and make the employer or the voluntary after tax contribution by their extended tax return deadline. So, in other words, as long as they file an extension for their business tax return, which is effectively their 1040, because their business is taxed as a sole proprietorship. Now, for all the other types of businesses, right? S corps, partnerships, C corps, if you didn't sign up with us before the end of last year, or you hadn't set up a plan somewhere else, like a basic solo 401k plan at a discount brokerage, then it's too late to make employee contributions for 2024. But there's still time to open up a plan and make employer or voluntary after-tax contributions, provided that the plan is set up in time to make those contributions by the business tax return deadline, including extension. So let's say that your business is taxed as an S corp, and you file an extension for your 1120S. That means that you could set up a plan in 2024 and still make voluntary after tax, in other words, mega backdoor Roth, and or employer contributions by September 15th, 2025. All right, so it looks like that takes us to the end of the questions for today. Thank you so much for joining. Please continue to engage. You can join us on our community, mysolo401k.net/my community. You can follow us on YouTube. You can please like this video if you find it helpful. It helps us get the word out. We really appreciate the chance to discuss these topics. So until next time, take care, everyone.